So the case numbers we're talking about, basically zero versus the vaccine. What's the market preferring at the moment? What's more important?
I think I'd probably look at it a little bit differently for you there, Tom. It's not just what's going on here in Australia. We've obviously got zero cases. It's more about what's happening overseas and the surge in cases now and what we saw on Monday around the update from Pfizer and whether or not a vaccine is going to be there. Under market theory, the market's always looking 12 months ahead. And therefore, to answer your question, it's probably the vaccine, because the expectation is this time next year, a vaccine will probably be multiple vaccines, considering how many are actually now through stage 3 trials, how many will probably be rolled out by March next year. So that's been the question, because there's been a lot of talk in the US overnight about the fact that they are making record all-time highs with the amount of cases being recorded. It's now, 143,000 cases last night in the US. They're also in Europe seeing levels of deaths, unfortunately, not seen since April. Yet markets are looking through that, and it probably is down to the vaccine. There has been some tempered movement in the last sort of 48 hours, but overall, it is now the vaccine that's becoming more important, because the economic expansion that will come with the herd immunity that comes with a vaccine is clearly what's also now playing into people's thinking longer term, and we're getting a bit more excited by that.
Yeah, again, I guess that feeds into all sorts of things that we can't change, no matter how well we manage things such as overseas students, tourism and so on. Let's look ahead to some data next week. So we've got employment data, wage price index, and also labour force data. So so many of these things are sort of affected at the moment by various government programs. What are you expecting?
Yeah, and exactly that. So the reason I highlight it too is that it's now almost by stealth become the RBA's main mandate of what they're going to be doing over not just the next 12 months, but probably over the next decade. And that's why employment now becomes more and more and more important to how you look at how governments and fiscal side, how monetary policy on the bank side will probably behave. Unemployment and the labour force numbers are going to be very interesting, because it is going to be the numbers for October, and it's actually the survey's done at the back end of October and will probably catch the first 4 or 5 days of November. Why that's important, Victoria was now well and truly opening up. So there should be another burst. There should be another increase in employment gains. It'll be a question of what we saw back in sort of, July, August, which you and I, Tom, have talked about before, about the amount of self-employed people that came out of that. So those that are on sole trading sort of licenses or ATO numbers. That will be a question, but expectation is that labour force numbers will jump. Why you need to highlight, though, the wage price index, and this is where the RBA comes into it. They know that wages have gone back. You've already alluded to JobKeeper and JobSeeker, but wage growth in this country, even before COVID, was anemic. The expectation now is that it's actually going to decline and probably go backwards for at least the next year. So that is where the support needs to come from. Keeping wages up, keeping wages at least at a level that were sustainable to sort of hold us to maybe just shy of pre-COVID levels helps confidence. I mean, you alluded to it before, things like tourism, things like education, which are massive parts of our GDP. They have been significantly impacted by this, but it's not just that. It's also then, the providers that come with it, restaurants, et cetera, which come from tourism. So wage price index for me is probably the one to watch next week, and it looks like being negative, and that's where the government needs to be in front foot, continuing to support the economy as much as possible.
All right, we'll see, and particularly, if it's negative and what the government reaction to that is. All right, so 7 weeks to go this year. We've had some shocks to the economy, it's fair to say.
Just a little bit.
Markets extraordinarily strong of late, though. Any late surprises left?
There's only probably one left from a geopolitical/surprise idea, and that is coming out of Europe. Don't forget, the 31st of December this year is supposed to be the signed, sealed and delivered finalisation of Brexit. COVID's clearly got in the way of actually having Brussels and Westminster sit down and talk and get it all done. There is growing signs that the UK at the final hurdle could crash out. And that's probably the only surprise left now in terms of what could happen in 2020 or some form of adverse effect with COVID. That's obviously always there. But in terms of that question, it's Brexit now. And I know we've been talking about this since 2016 when it originally happened, but it is at that final hurdle and it is growing. About, some people believe in as much as a 70% chance that the UK will crash out of the EU without a deal. And that would be a big, big shock for global markets and particularly for the European and UK economies.